In this learning objective, we discuss the advantages associated with international diversification within a portfolio. There are several different advantages of internationally diversifying a portfolio. First of all, when one internationally diversifies, they expand the feasible set of investments across all stocks that exist in the international markets that they're now accessing. We know that across international stock markets, there's going to be the opportunity to invest in stocks that have a wide range of different characteristics with respect to risk and return. And it may be that you can actually access risk and return characteristics that aren't possible within your own domestic market. However, the most important reason for considering international diversification is because of the diversification benefits that can be achieved. Cross-market correlations are almost always less than 1. So because we've got less than perfectly correlated markets, it means that when we internationally diversify, we can achieve benefits by lowering the overall level of risk within our portfolio. And often we can achieve a level of risk in our overall diversified portfolio when we invest internationally that is lower than the risk that can be achieved by just investing in a diversified portfolio within our home country. Some other reasons, though, are that, first of all, some larger firms are often overseas. So if you're an Australian investor, some of the largest multinational companies are not listed in the Australian securities market. So if you just invested domestically, you wouldn't be able to get access to investing in those stocks. And also, other markets around the world might have different characteristics compared with domestic markets. In particular, if we look at emerging markets, we know that they tend to have higher risk and higher return compared with developed markets, and that might suit the risk and return appetite of a particular investor. So to summarise the risk and return characteristics of different markets around the world, we can see this table from the Bodie-Kaner Markets textbook, which provides a summary of the average returns and standard deviation of returns across a range of countries in the decade from 2000 to 2009. Now, what we know about this decade was that it did include the global financial crisis, which is why in some countries, such as the United States, the average excess return per month was actually negative. As we look down this list of developed countries, we can see that there's quite a lot of variation across the average returns. Interestingly, Australia was one market that did very well during this period, and that's consistent with the argument that Australia was relatively immune to the global financial crisis, at least relatively compared to other markets, did not suffer as big a drawdown, and also what we know is that the GFC followed a significant rally in the Australian stock market due to the mining boom. We can also see significant differences across the standard deviation of returns throughout these markets. So some markets like Finland and Korea have a much higher standard deviation of returns, whereas the US and Japan, on average, the standard deviation of monthly returns in those markets is much lower. What's particularly interesting, though, is contrasting the risk and return characteristics across these developed markets with the risk and return characteristics across emerging markets. What we can see here is that across the same 10-year period, we're getting substantially higher average returns. Average returns here up in the ballpark of around 2% per month when denominated in US dollars, compared with developed markets, which have an average return of probably about 0.5% per month. However, the flip side is the standard deviation of returns is also substantially higher, and we also find that the beta compared with the US market tends to be above 1, which means that these markets co-vary significantly with the US market and have a very large standard deviation of returns, so they're quite risky. But the returns column at least shows that there may be some benefit in investing in emerging markets. So what if we're an investor, what if we think about moving forward beyond this 2009 period, might there be some benefits in considering emerging markets? Well, one thing that we note is that while there were substantial returns across that decade from 2000 to 2010, largely as emerging markets became more integrated with world markets and became more accessible to foreign investors, we've actually found that there has been a closing of the value gap that previously existed. So we can definitely say that along that decade there appeared to be opportunities to invest in emerging markets because those particular markets tend to, on average, be underpriced. And we can kind of see that because looking 2004, 2005, 2006, comparing the PE ratio of developed and emerging markets, the PE ratio of emerging markets was substantially lower than developed markets. However, the global financial crisis period actually brought the PE ratios of developed and emerging markets much closer together. And from 2010 onwards, we can see that the PE ratios of emerging and developed markets on average tend to be quite similar. So this might be one reason to suggest that potentially those abnormal returns that were generated by emerging markets over that previous decade, we might not necessarily see such large abnormal returns in the future. However, we would still expect to see higher returns in emerging markets as compensation for the higher level of risk within those markets. But we can see quite strong evidence that there are different risk-return characteristics. So that's one reason why investors might consider investing internationally. Second reason is related to diversification. We know that there are diversification benefits whenever you combine two assets together that have a correlation less than 1. And if we look at the correlation of returns across international markets, we can see that those correlations tend to be less than 1 through time. We can see, for example, looking at the correlation between the Australian market and the US market was 0.47 in the 70s and 80s, 0.36 in the first half of the 90s, 0.64 in the second half of the 90s, and 0.79 in the 2000s. So you can see all through time there are some diversification benefits that can be achieved. So investing globally can reduce the overall risk exposure of your portfolio. But once again, there's another fly in the ointment that needs to be considered here, because if we look at this table from right to left, what we can see that the magnitude of these correlation coefficients have actually increased across time. That is, markets tend to be becoming more integrated, which means that the diversification benefits that can be achieved by diversifying globally have actually become less. We know diversification benefits are greater when the correlation is less, but correlation in recent times has increased in markets. So while in this decade of the 2000s there were still some diversification benefits, they were much smaller than what they were in the 70s and the 80s. However, because there still is some benefit to diversifying across international markets, and because the correlations, and that's observed because correlations are less than 1, what we can think about is we can think about this idea of diversifying and the associated risk reduction that we've spoken about before in the context of adding international stocks in our portfolio. So this black line relationship we've previously seen, that is the relationship between the number of stocks that you have in your portfolio along the x-axis and the average portfolio risk on your y-axis. So we know that there's a significant reduction in risk as you go from 1 up to about 10 assets, and then eventually risk asymptotes, and it asymptotes at this level of systematic risk, which is risk that can't be diversified away. However, because markets are less than perfectly correlated, we can actually lower the level of systematic risk through a global portfolio. And what we find is that the diversification benefits are such that that baseline level of risk that can be achieved in a global portfolio is actually lower than the baseline level of risk that can be achieved in a domestic-only portfolio. We can also think about this in the context of an efficient frontier. So if I think of an efficient frontier here, I've got the returns across 7 countries through time. So each of these dots would be the average returns and the risk that would be achieved by investing in any of these markets in terms of monthly return and monthly standard deviation of returns. But if we were to put these risk and return characteristics into Solver and derive an efficient frontier comprising portfolios that we can construct using a combination of each of these countries, that efficient frontier looks like this green line. And we can see that that combination of internationally diversified portfolios is substantially superior to investing in any one market of its own. So there are benefits through these diversification benefits that can be achieved. Once again, though, another thing that needs to be considered is how those diversification benefits might vary across market states. And what we find is that there is a variation in terms of correlations through time, whereby markets tend to become significantly more correlated during periods of market crisis and are less correlated during normal times. Now this is a problem because the one time that you really need diversification to work most is during those periods of crisis, but that's the one time where it actually works least. Let's just illustrate that on the screen here. What we've got is the blue lines are the correlations between these international markets and the US market during periods where the US market earned a positive return. And the maroon coloured bars, that's the correlation between international markets and the US market in months where the US market was declining in value. And what we can see is the maroon lines across the board are higher than the blue coloured lines, which means that the correlations are higher during down markets, when US market earns a negative return, than what they are in up markets. We observed this panel with respect to developed markets, and we observed the same phenomena in emerging markets. So while the aggregate level of correlation tends to be lower between emerging markets and the US, we can still see this variation through time where correlation with the US market is much higher during down markets and much lower during up markets. Another way to think about that is to look at specific events. So if we can think of some key events through time, well, what I'm looking at here is the dot-com bubble and what happened between the correlation between the US stock market and the world index ex-US, so basically the average of the rest of the world. What we can see is that during that dot-com bubble, that crisis period in the early 2000s, the correlations increased quite substantially. So we saw the correlations tracking about 0.5 or 0.4 through time, and then in terms of both of these indices that we're comparing to, there was this substantial spike. We actually saw the same thing happen in 1987 during the stock market crash in 1987. What we can see here is that on the date of the crash itself, it wasn't just one market that moved down, but here we've got a range of different global markets all around the world, and you can see that they're all moving down together, which is suggesting that there's a high amount of correlation. These markets are co-moving, and that's again consistent with this idea that markets do tend to be highly correlated during periods of crisis. So overall, when we look at the benefits of investing internationally, we can see that you can achieve some different risk and return characteristics. Particularly investing in emerging markets can give you exposure to markets that on average have higher returns. And we can also achieve diversification benefits. But 2 points that we have to be wary of is, first of all, those excess returns generated by emerging markets appear to be dissipating in recent times. And second of all, there also tends to be increased integration across international markets, which is meaning that correlations between global markets is increasing. Hence, those benefits that you can achieve by diversifying across global markets are unfortunately getting less.